Lakshman, very nice to meet you. Welcome to F.A.C.E.
Oh, hey,
Really,
Dale.
it's really great to talk to you. I'm not sure if you have any slides or anything you want to show. Otherwise, I could just share my screen and we could talk.
Yeah,
Hear
I
that?
think maybe talking to start, and then we'll
Okay.
we'll take it from there. If
Okay.
if I have to root around to get something, I'll do that
You
and
know, I've
share.
been
You
watching you for so long,
you
Yep.
Lakshman,
can
and
switch on your camera again if
Yeah,
you
yeah,
want.
yeah. Here, I'm here. Hi. Hi,
Dale,
okay.
everybody.
you can just switch to camera speaking if.
I have a background you won't care for, Steve. I appreciate the producer. But I would like to welcome you. I've been a fan for a long time, and a lot of your turning point work and your calls have been very prescient over the years. And I just want to let people know that Lakshman has been running the Economic Cycle Research Institute for how long now, buddy?
Oh gosh. Well, I guess you accumulate responsibilities over time, right? So,
Right.
I cut my teeth on this in 1990. At the first, that was my first recession, real time, when I
Okay.
was really focused. And I mean, I experienced recessions before, but I didn't think I really knew what was going on. I was a little younger, and been running. At that time we were a part of Columbia University,
Okay.
and then we went private in the middle of the 90s, and so I've been kind of helping to run everything since then. We got a great team. It's not all me. I got a lot of really really talented people working with that
So how
group.
did this happen for you? Did you have an epiphany in high school and one day after school you said, you know what? I'm going to become an economist.
You know,
What?
in
Tell
a
us the
weird,
genesis.
yeah, no, it's a great question, right? You're always like, first you're blessed if you could do something you enjoy doing. So I'm
Amen.
interested in it, and so I'm
Yeah.
really really blessed for that. To in a weird way, it has to do with FX. Not that I forecast FX, right? But
Right.
I was out of high school before college, and I got a Eurail pass with my buddy, and I had a tight budget because my parents didn't want to really support my venture, and and I went off, backpacking around Europe, and I had my budget, and as you do, you blow through your budget.
Yeah.
And then I found out, well, if I go from one country to another country, this is in the mid 80s, so the
All right.
dollar was strong,
Yeah.
and my budget gets repaired by this weird foreign exchange thing that's happening.
Yeah.
And
You
so
were long Europe, long the dollar.
I was
Yeah.
long the dollar, basically, right? And
Yeah.
I'm just trading it into these different currencies as I'm running around. And I was like, what the heck is that? How does that work? And got interested in economics, which seemed a little contrived at times. And when I was introduced to Dr. Moore, my mentor, by another
Right.
teacher of mine who had worked with him, uh, it wasn't so contrived. The cyclical work was much more observational. There's a lot of theory behind the observation that
Yes.
we're tracking, and what I liked is it was global. It was something that worked around the world. This framework, the cyclical framework, presuming that you're in an economy that is dominated by free market activity. Doesn't have to be completely free market. I don't know
Yeah,
if
because
anyone
we're
actually.
not now, are we? We
No,
haven't
we're
been.
not.
I mean, this is central planning for a long time, right, Lakshman? Did that cloud or at times perhaps the picture because you have central planning and the Fed involved in a way that they never were before, make it more difficult to forecast?
If you have good indexes, I mean, there's no holy grail, right?
Right.
So in our coincident data, it's all hard data, like actual counting of stuff. In our forward-looking data, you get three choices of data, right? You have market data, you have government data, and you have survey data, and you have to try to make something out of that. And So goofing around on from the monetary side, sure, it has impacts. It's a driver of the cycle. It's
Yeah.
not the only driver of the cycle. There are others. And so it's really when they start working in concert that you get the pronounced, pervasive, and persistent moves. So that's why I was careful to say predominantly market oriented.
Yes.
We've observed, good examples of this. We've always tried to break the approach, right? Where does the cyclical indicator approach fail? And interestingly enough, back at Columbia, some researchers from the USSR, the former USSR, showed up. And after a lot of vodka drinking and whatnot, we got down to looking at indicators, and we saw that it doesn't work. Thank goodness, in a centrally planned economy, right?
Yeah.
Now we've having done this over and over again, we basically see that it fails in centrally planned economies that are dominated by central planning. Truly big war-torn economies. So we've seen that on occasion in some Middle Eastern economies, and serious weather events like a 6-year winter, from a volcano, that kind of thing.
Right, earth change.
So in India, which was a managed economy, post 90s, where it's less managed, but it's still managed. But some price controls came off and things like that. You see cycles start to emerge. Same with even China, which is certainly a heavily managed economy. We've seen cycles emerge as free market activity has increased in terms of the impact on their economy. Okay. So it's
there's no holy grail, but
no holy grail.
I pay attention to what you say, and I saw an interview, maybe it was a month ago, you were on CNBC. And you were talking about how the economy was slowing, and the interviewers were pushing back on, economic growth and a consumer balance sheet. And you were talking about we are slowing into a tightening cycle. So bring us up to speed with what you're seeing now in the U.S. And has it even been exacerbated by what is happening in Ukraine?
Yeah. So let me take that in two pieces. What's happening in the cycles leading up to Ukraine, and then we'll layer Ukraine on top. And I kind of think I actually do think. I mean, look, I'm converted. I think cycles are important. I think they're bigger than virtually most of the things that are going to hit the headlines. I don't want to say never, but I was like virtually everything. So going into the, several weeks ago, let's say a few weeks ago, you basically had a growth rate cycle downturn that is well underway. In fact, now I do want to share a screen.
Okay, so I'm going to stop sharing, and you
don't mind.
Go ahead.
I apologize for clicking around. I'm not the best on the computer, but I will try to do my best.
You're doing great. So here we go.
Right. Tell me, what are you seeing?
Yeah.
Are you seeing a chart?
Yeah, we're seeing the U.S. coincident index growth rate.
Yeah. All right. So this is look. I mean, it's hard to agree on facts sometimes, but I would say this is reality. All right. This is a coincident index. It is how we define the economy right outside your window. And so my mentor, Jeffrey Moore, was the one who dated all the business cycles through the end of the 70s. And then he was the head of the dating committee until he passed away in the earlier part of this century. And he would be basically looking at this type of line. This line includes output. So you could think industrial production or GDP, that kind of stuff, stuff we produce. It's including services, employment, all the different measures of employment, right? Because none of them are right, but you take them together and they're generally okay. Sales, much broader than retail sales, aggregate sales of the entire economy, all the business stuff and up the supply chain, and incomes all across the economy. So again, output, employment, sales, and income. And that's that line. That's the growth rate in that line. And so you see a reset. Here's the, it's not literally this way, but it's roughly when it goes negative, you're in recession. Okay.
Okay.
So here you have, boom, COVID. This is basically March right in there. Okay.
Yeah.
And then we rebound. And this, excuse me.
It looks like the S&Ps.
Yeah. No, it does, doesn't it? So this here, we're doing a little bit of COVID stuff. This real sharp thing is, some of the stimmy stuff, stimmy checks, and all the buying of the goods,
right,
over services. And so you have this incredible run up. This is last spring.
Right.
We peak out and we start slowing. It's not the end of the world. In fact, this pattern that you see right here of a sharp rebound from a decent recession or sharp recession, totally typical. It lasts for about a year, and you need to figure out when it's ending, you got to watch leading indexes. And so anytime, I'm going to make a blanket assertion, and we could talk about it later if you want, but any recession, the rebound from the recession is good for about a year. And then it's
like a bear market rally, isn't it, Lakshman? They're sharp,
sure,
but they don't hold.
No. And so right here, look, you could think back to coming out of the financial crisis. In 2010, we're slowing and nobody wanted to believe it. So here we are slowing, and this is all pre-Ukraine. Okay.
Right.
And it's a pretty decent slowdown. You're under 2%. And this slowdown, by the way, is not simply goods. It's also slowdown in consumption on services, in particular, real consumption on services. So this is the reality. Now the Fed is tightening into that slowdown. So super simple. Again, I don't think I'm saying anything radical here. If you're slowing down already, tapping on the brakes, you're going to maybe slow down more than you expected.
Right.
Okay. That's, it's not a radical statement. So that's
have you ever seen a setup like this, Lakshman, where the economy was weakening? There was a global war. I think someone brought up the point that a big war, that the Fed rarely tightens in a geopolitical event like that.
Right. And so, we have seen this before. We have seen this before. So there's you can have in-sample data, out-of-sample data. This is a lot of our work is out-of-sample real-time stuff that I'm going to be talking about. We have done some out-of-sample development of our leading indexes all the way back to the early part of the 1900s. Okay, so very far back. So we see some what cycles are looking like with our indicators around these big events. So going into World War II, right? Pearl Harbor, pretty big. This is World War II. This is not going into, that's in World War II.
Yeah.
It did not trigger a recession because the coincident data wasn't cycling down like this. And more importantly, the forward-looking data was moving to the upside. The stuff that leads the coincident indicator was moving to the upside. So the economy's kind of immune system was pretty strong. And it took a while to get the war spending going on that would really boost economic growth. And in that intervening period, there's no recession, even though there's this huge negative shock.
Yeah.
Because of where we were in the business cycle. In contrast, in 1990, when I started doing working with the team, we had a war. It was not a world war. It's the
Gulf
Iraq
War.
War. Yeah, the Gulf
Yeah.
War.
Mhm.
And there in February of 90, it's so hard to remember this stuff because we get so much data coming in. But in February of 90, our indicators were much weaker, right? The forward-looking data was recessionary. And so the immune system is compromised, the window of vulnerability is open. Virtually any shock would qualify as any negative shock would qualify as a recessionary shock. And so we were on basically watch. Hey, this thing is in trouble. And then months later, I think it was in August, the 1st of August, that Saddam Hussein invaded Kuwait. And you could predict pretty easily there's an oil price shock because of that going on.
But
And
the Fed wasn't tightening during that war, right?
no, they
Or
didn't cut. They're still just out of sync. They didn't cut until October. They didn't know we were in a recession. You go to 2008, which may be, I was talking to some clients the other day they're not fund managers, but they're in heavy equipment and things like that. And they are booming, right? So they're booming because of the commodity stuff.
Yeah.
But they know, like anybody who's in commodities for a while knows it's volatile, right? It could go up and it can go down. I heard your guest before saying, it was somebody talking that it could come down and go the other way. And they were like, okay, history does not repeat itself, but this echo, remember 08. So the recession, the financial recession, different shock, right? There's a housing bust. But the recession begins at the end of 07. In a fit of bipartisanship. I forget who all was it Bernanke and Bush and Paulson or Pelosi. They all got together and they were like, okay, we're going to give a stimulus.
TARP.
And this is really early. This is like, I think they got it done by this first quarter of 08, but the checks didn't hit kind of till the second quarter. So you have GDP holds up a little bit in the second quarter, and right in there, oil goes to 147, right, which is a lot more in today's dollars, by the way. Right. And that's inside of a recession that it spikes up like that, and then it corrected in a big way, right?
Yes.
And at that time, by the way, also, and this was now flip over from the hard economy, real economy to the financial economy. The Fed was promising 4 rate hikes, 100 basis points of rate hikes before year end, inside of a recession. No, none of that happened, right? So, but that's where the market was priced in Q2 of 08. This is totally different. Look, I don't have any particular insight on what's going to happen geopolitically. But right now, the Fed, fast forward to Ukraine on top of all this, and the Fed, the Fed's behind the curve. They misjudged inflation. They thought it would be transitory because they don't understand inflation cycles. Basically, this goes back to their mistake in 2018. Where they, as a result of making a mistake and not understanding that inflation was not running up in 2018, they decided that inflation would practically never be a problem, and that the Phillips curve was really flat and blah, blah, blah. So that's why when inflation started popping up in 20, we had an inflation cycle upturn in the fall of 2020, cyclical one. That's why they thought it was temporary. So they're like, oh, we don't have to forecast inflation. We know it's going to be down. It's just a temporary thing. And so, having made another policy mistake, they have to hike here. On top of this Ukraine thing is just having them decide between 2 policy mistakes. Right. They back off. If they back off for any reason, inflation gets more embedded than it already is. And if they tighten, they're tightening into this slowdown, which gives them the narrowest of paths to a soft landing.
Okay. So two steps. Remember 2 steps in a stumble?
Yep.
All right. You think that they're going to be able to make that much progress? They'll be able to do that.
To get
And,
2?
Yeah, get 2 in, 2, 3 in.
Look, now we go to the reaction function, right? I'm putting words in the market's mouth or the Fed's mouth, but let's say it used to be, if we got to double-digit correction on the S&P, they changed their tune. And so now who knows, is it 20, 25%? And they changed their tune. So I think that if as they're tightening, the policy mistake that they're choosing, right, is that the market could break, and their reaction function isn't simply 10-ish% anymore. It's much higher than that on S&P, and a recession. I mean, our forward indicators are very prompt. Look, we've been doing cycle stuff for 3 generations. I mean, literally, it's almost a century. We defined what a cycle was, my mentors, and as far as I know, we're pretty good. I don't know if anyone who's any better at forward look risk on a recession. And I could, in my gut, say, whoa, look at the headlines. It's so nasty. It's a guaranteed recession. But that's not our process. Our process is that we watch our forward data. And if the forward-looking indicators are showing a pronounced, pervasive, and persistent decline in the level of the leading indexes, not the growth rates, then your window of vulnerability is open. Any shock is virtually a negative recessionary shock. And so,
how about on top of it, Lakshman,
Yep.
that we've been having, and you talk about it in your newsletter about the commodity currencies, the Aussie, Canadian producing countries have had an edge over importing countries. And do you think this is the beginning of a major trend in commodities, and it's more than supply chain? And the second part of the question is, how could higher rates, and I was around when Volcker was tightening, how could higher rates bring down the price of agricultural commodities, maybe economically sensitive ones, but not basic things like food and certain type of metals? How can the Fed can't print corn, Lakshman?
I'm smiling because I'm working off my COVID pounds, like everybody else. And I think we're in for some proverbial belt tightening, right?
Yeah.
Which includes, to a degree, food, as well. I was making a connection. But the first, let me start with the cyclical, and then we'll get to this structural. So the cyclical stuff, by and large, is on demand. It's on the demand side.
Right.
So on the supply side, if this country or that country comes online or goes offline for supply of a commodity, that's not something that's very cleanly getting into our cyclical analysis. It's mostly on the focus
aberration.
And so, well, no, it's not an aberration. It's a real thing, right? So the price is supply and demand. That is what it is. Both of these, we got 2 bogeys moving around, and we're able to track the inflections, the pronounced, pervasive, and persistent inflections on the demand side. So the demand side is already coming down. The problem is, the problem, I don't know what, but the prices are rising because the supply came down quicker, right?
Right.
And what's going to happen there? So I think you're absolutely right. The Fed can't impact supply very easily. It may be, and again, this is, I'm kind of just speculating here, that you now go back to Volcker. You take a recession as a policy choice,
right,
to kill inflation. So there was a clip I saw of I think it was Senator Shelby, if I'm not mistaken, in Q&A with Volcker a few days ago. Excuse me, with Powell a few days ago.
Okay.
And Powell said he could, or he'd like the history books to he'd be fine with them saying that he followed in Volcker's footsteps and
Wow.
hike as needed to quell inflation. My mentor, Jeffrey Moore, once quipped to me that, one of the only truisms in economics is that recessions kill inflation.
Okay.
And so go back to 08, oil's at 147 in those dollars, and it did come back down with that was a big recession, right? So that is a scenario we have to watch for. The cyclical backdrop for that is a global industrial slowdown that is ongoing. It hasn't stopped. It has nothing. It actually wasn't the result of COVID coming on or off, rising up or coming down. The global industrial slowdown wasn't.
What's going on before COVID, wasn't it?
It's a well-established one. The problem there is that our forward-looking data there is not showing an upturn. So that means that independent of the headlines of the last several weeks, the cyclical backdrop, which I would argue in almost all cases is bigger, did not see an upturn. The farthest we could see with clarity is a couple of quarters, maybe. Yeah. So you're talking, toward the end of the year might be the earliest you'd have a clean trough in global industrial growth. So that means there's some room in front of us. Now, the market focuses on PMIs or spot prices, right?
Right.
And, the PMIs are going to go down. They were already going down, but they're going down from a high level because of the earlier spike. Right. So when they come down and they're like, oh, in the 50s or 60s or wherever, it's like, oh, they're pretty good. But it's really the vector that's important. And I think people will really wake up when they cross the 50 line.
Okay. Very enlightening. I could talk to you for a long time.
Well, let's do it again.
Yeah, we will do it again. And right. The best way for people to follow you, would it be to go to your website at businesscycle.com or Twitter?
Businesscycle.com. And then, I've basically there's more in-depth stuff on businesscycle.com, but then just on Twitter at Business Cycle, or I think it's kind of the same thing on LinkedIn. Instagram. Maybe I even have it here. There it is.
Okay, great page.
Business Cycle and LinkedIn, and you can follow us. Watch the weekly leading index. It's coming out at 10:30.
Okay.
This morning, and that's a very prompt read. It's already starting to pull in some of the Ukraine impact. And real quick, big market corrections I'm showing on the screen, double-digit ones. They happen inside these shaded areas, which are growth rate cycle downturns. This is in the QE era, all here. Nice. And we're in the middle of one, and the downturn is not over. This thing's going to keep edging down.
Okay. So you heard it from Lakshman, and really, I've been admiring your work from afar for a long time. Honored to meet you and talk to you.
Well, and
appreciate you edifying the F.A.C.E community today.
Thank you very much, you guys. Everybody have a great weekend, and we'll be in touch.
All right, Lakshman. I hope everyone enjoyed it. People are saying thank you. Very valuable insights. You have a great weekend, and we'll be in touch quite soon, Lakshman. Really nice to meet you.
You too.
All right. Can you send me an 8x10 autograph picture?
Sure.
All right, buddy.
I got one in front of the Empire State Building. I'll send you that one.
Okay, everyone. Lakshman, what a great interview. Adios.
Bye.
So everyone, that's a wrap. You could join the team in 13 minutes for the Morning Edge. Hope you enjoyed the interviews this week and all the great actionable ideas in F.A.C.E. And if you want to say thank you, check out the Trader Funding Program and Dare to Dream. More than that, Don't just count your pips, count your blessings, everyone. And we'll see you next week. See you, Monica. Bye. Bye, Mary. Rick, you too, buddy.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.